it is shocking to me that the Fed never talks about money supply. We think we're going to see a bit of a harder landing here than many people expect.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
M2 officially now dropped 4.6% on a year-over-year basis in April. And we think that it will continue to accelerate to the downside. We think it'll be down 5% or more in May. I'll say it again. It is shocking to me that the Fed never talks about money supply. I was early in my career when Fed Chairman Volcker was focused on inflation, and all we talked about was money supply. So quite a big difference. So the question now is the Fed going to pause? And we keep getting different stories from different Fed governors and presidents and so forth. If you look at the two variables that the Fed has focused us on, employment, and you look at the headline numbers, including today's, we'll get into that in a moment, you'd say, no way are they going to pause. They're going to keep lifting rates. Employment is too strong. If you look at the details inside today's report, and maybe I will go through that now, you'll see that they may be having second thoughts. While the headline number, non-farm payroll, was up 339,000, I believe, much stronger than the 250 to 280,000 expected. Another number, which is actually a leading indicator of employment, but it's buried deeply into the report, is called household employment. So payroll employment is a survey of corporations. Household employment is a survey of households. And that number was down 310,000, which is pretty shocking to see that kind of a divergence. But it does happen at turning points in the cycle. And it has happened a number of times in the last really year and a half. We've seen the 3-month moving average of the household employment numbers go negative, while the non-farm payroll numbers churn ahead. And what might explain this? In our view, it could be because the payroll employment just counts the number of jobs. Household employment, those workers, some of them are working 2 and 3 jobs at a time. And but they're just one person employed. So it could be that they are losing some of those jobs. We will see. It tends to capture the small and medium businesses more than the non-farm payroll does. And they're the first to lay off people. So that may be what's going on. If you look at the CPI, well, the Fed is going to have some interesting statistics, we think, in the next couple of months. And it's mostly because of what happened last year as opposed to this year. It looks like the CPI is settling into the 0.1 to 0.3 range. The comparison from last year for May was 0.9, and for June it was 1.2. That's month to month. So we're going to be dropping off some big numbers here, and we wouldn't be surprised to see the number in July, reported in July for June, to be around 3%. And to give you a sense of that, a year ago, June, the number on a year-over-year basis was 9. So 9 to 3 within 1 year's time. And we think the evidence is brewing that that number is going to continue down and probably will go negative. And when the Fed recognizes that that is the case, as we believe they will, there are all kinds of leading indicators, which I'll share with you in a minute, then it is going to change its tune. And by that time, we're probably going to see more increases in the unemployment rate. So today we got an increase from 3.4% to 3.7%. And the reason was that household measure fell 310,000, while the labor force, so the people out there looking for work, actually increased by nearly 150,000 people. So that's a 0.3 of an increase in the unemployment rate. The other negative piece of news from an economic activity point of view was that the work week shrank by 0.3%. And that has a disproportionate impact. It doesn't sound like a lot. 0.1 hours equals 0.3%, but it is a depressant on economic indicators. And in fact, if you look at total hours worked in the economy, they have essentially been flat to slightly down now since January. So there are a number of employment-related indicators that are suggesting weakness, even though there are others, like the JOLTS index, job openings soared in the last month. Initial claims started coming down again. The Challenger job survey, that one showed that layoffs surged 287% year over year. These are layoffs of, they're reductions in force, so a layoff of a group of people at the same time. So we're getting all kinds of conflicting indicators, which is, again, typical at turning points. And you'll know I've been using that phrase, turning points, for a while now. And one of the reasons for that is it does feel like we've been through rolling recessions, housing and autos, 2 negative GDP quarters in the first half of last year. And so it feels like this is one heck of an extended turning point in the economy. It was interesting to note today that Larry Summers came out again. I mean, he's all over the place. He was, an extreme hawk at one point. Hawk means he was suggesting that the Fed continue to raise interest rates by 75 basis points at a clip, and then he pulled back when he saw some economic weakness. Now he's saying, well, if they pause, they should increase by 50 basis points in July. So we've still got a lot of people out there who do not believe that the Fed has conquered inflation and who do believe that we're in a 70s style inflation. We just think that's flat out wrong. The other thing that I'd like to update on was something that we started to share a couple of months ago, and that is this identity, MV equals PQ. And if you'll remember, PQ is nominal GDP, and MV is money times the rate at which money turns over in the economy per year. That's called velocity. So MV must equal PQ. That's an identity. So we've got the first quarter numbers in. I talked about them last time around. Nominal GDP was up 7% in the first quarter, but money was down about 2% on average for the quarter, M2 on a year-over-year basis. And so what did that mean? That meant velocity increased 9% to offset that decline in money. Now, the second quarter consensus expectation for GDP, nominal GDP, both price and units, is 6%, 5 to 6%. But we already know that money is going to be down about 5%. That means velocity has to accelerate to 10 to 11% to make that identity work if GDP is up 5 to 6%. Now, we had the regional bank crisis at the end of March, and we don't think it's over. We think deposits will continue to outflow, seeking higher yields in money market funds. So that crisis is not over. And crises tend to hurt velocity, meaning businesses and consumers pull back and they don't spend money quite as quickly, and they start cutting budgets and they start laying people off. And, you get into a little bit of a vicious cycle such that velocity actually falls. Now, if you assume velocity doesn't fall but does flatten out, is flat on average from the first quarter to the second quarter, then what would have to happen, what that would translate into is a year-over-year increase of only 8%, not that 10 to 11% that we need in order to get that 5 to 6% in nominal GDP growth. That is why we think we're going to see a bit of a harder landing here than many people expect. It's velocity not continuing to accelerate. And so what will that mean? It means that something will have to give in nominal GDP, either pricing or units or both. So we would not be surprised to see nominal GDP growth on a year-over-year basis disappoint in the second quarter. And if not the second quarter, then certainly the third quarter. That is how we get our hard landing.